migraine. Imagine someone sawed open your head, filled it with razors, and shook it as hard as they could.
Taxes are a headache, but Canadian taxes are more like a brain-splitting migraine, especially if you're a newcomer to the country. But don't worry, here's our list of 6 essential things to know about them. Hey, by the way, don't forget to subscribe for more informative real estate content. Fact 1. Sources of income. In Canada, you can earn income from employment, business ventures, and investment. Fact 2. Income tax. In Canada, you have to pay 2 levels of income tax, federal and provincial. Federal tax applies the same way to everyone across the country, but provincial tax differs by region. Here's 2 examples. To make life easier, you can use online calculators like this one. Fact 3. Progressive taxation, meaning that the more you earn, the more you pay. To find out how it works, click on the video card above. Fact 4. Tax credits. Tax credits help reduce the tax you pay on your taxable income and are given out by both federal and provincial governments. There are 2 types. Non-refundable tax credits, which will simply deduct your tax until either you run out of credits or your tax payable hits 0. Refundable tax credits, which will be paid back to you if you still have credits remaining after canceling out your taxes. Here's 2 examples of tax credits. Personal amount. This is an amount every Canadian taxpayers can set aside and claim non-refundable tax credits on. In 2021, the tax credit for federal taxes was $2,071.20. Home buyer's amount. This is a non-refundable rebate targeted at first-time buyers and can cut off up to 750 Canadian of federal taxes. There's many others as listed here that you can search for an official government website. Fact 5. TFSA. TFSA stands for Tax-Free Savings Accounts and was started by the government in 2009. All the Canadian income that you put inside this account is tax-free. Even if you withdraw this money, it still won't be taxed.
Sound a little too good to be true.
You're lying!
Well, it is, and that's why there's certain limitation. The contribution limit to your TFSA starts being calculated once you turn 18, whether you use it or not. You cannot put in more money than the limit without incurring penalties. As you grow older, the total amount you can put into your TFSA increases annually. This annual contribution can differ by the year. Why is it important for you to know? Because TFSA should really be called TFIA, Tax-Free Investment Account. The key benefit here is that while there's a cap on how much money you can put in, there's no actual restriction on how much money the accounts can hold. So, if you invested using your TFSA and made $200,000, this income would not be penalized or taxed. Fact 6. RRSP. Another way to invest is through the RRSP, which stands for Registered Retirement Saving Plan. All Canadian income put inside this type of account is also tax-free. But unlike the TFSA, it will be taxed when withdrawn. You can open an RRSP account the year after you start filing taxes, and your annual contribution limit will be 18% of your previous year's income in Canada, with a hard cap that changes every year. Just like the TFSA, your total contribution limit is cumulative and penalties apply for exceeding it. With this plan, you can use the amount you contribute to the RRSP to file tax deductions in any year, reducing your taxable income for that period. Plus, when you eventually retire and withdraw your RRSP investments, you'll be in a lower income bracket. Thus, the key benefit here is reducing the total amount of taxes you have to pay over your lifetime. Amazing, isn't it? Now, we all have a headache. But did you know that investment income is taxed far less heavily than income from employment? Sign up to our newsletter and follow our social media pages.